Hello and welcome to Let's Talk Business. Markets have snapped 2 weeks of gains to end lower today. Realty, consumer durables and energy sectors declined, whereas private banks were marginally up. Alex Matthew with the wrap of all the market action.
Well, it was a quiet end to the trading week for the Indian equity markets, with markets losing ground across the board. You had the Nifty 50 that dropped about 0.4%, and you had the broader markets that underperformed. You had the mid-cap and the small-cap index losing about 0.9 and 0.8% respectively. Now, most of the selling was in a few pockets, though most sectors ended in the red. You saw the FMCG stocks that underperformed, but you also saw selling in metals as well as public sector banks. Now, banks are going to be in focus over the weekend, of course, because you have 5 banks that will report their earnings for the second quarter. You have the likes of ICICI Bank as well as Kotak Mahindra Bank, IDBI Bank, RBL and Yes Bank all reporting their numbers on Saturday. Bond yields in the US have remained elevated of late, and in fact the 10-year Treasury yield hit that 5% mark, and that is essentially what has resulted in a sell-off in risk assets across the globe. If anything, the Indian equity markets have not fallen to the extent that certain other markets have. Higher bond yields, as you know, prompt risk-off sentiment generally. You have a few names that I'd like to mention in the top gainers on the Nifty 50. You have the likes of Kotak Mahindra Bank, as well as IndusInd Bank, Tata Consultancy Services, SBI Life, as well as Tata Consumer. Just a little over a dozen gainers, most of them losing ground. And the top losers, of course, were in that FMCG pack that I mentioned. ITC disappointing on the margin front, and in fact the PAT missing guidance or expectations as well. Tata Steel losing ground, and HUL reporting the lowest volume growth in as many as 6 quarters, also underperforming in trade today. Divi's Lab as well as BPCL were the other top losers. Now, a few other names that I'll mention from the broader markets. You had Century Textiles that dropped nearly 7% after Q2 loss of about 33 crore rupees. Titagarh Wagons gained another 6% in trade today, and that's because of another order win. You had United Breweries that gained close to 4% despite a decline in profit in the second quarter. And finally, Indraprastha Gas was one of the biggest losers in trade, losing over 10% on news of the potential adoption of the EV policy in New Delhi for the fleet operators, and that is seen as a negative. But all told, it was a quiet end to the trading week. Let's see how we trade at the start of next week.
All right, spotlight on the week ahead. Indian markets have fared well in the past 3 years. Will FIIs continue to invest more in Indian equities? Amit Sachdeva of HSBC Securities shares his insights.
Hitherto, China was not quite attractive. The latest data from China is a slightly more attractive number than what people might have thought. If they do indeed turn on the taps of the stimulus, then valuation-wise, it's way more attractive than a lot of markets. And if we consider that if indeed the semiconductor run has the bottom is reached, then South Korea also kind of comes up in valuation, maybe growth. Is that a counter to India's attractiveness in the region for global FIs?
No, I think this is a very good question because, look, India has been an outperforming market 3 years in a row, right? In 21, it outperformed. 22, although it was negative, it still outperformed the region. 23, again, it outperformed, although the first quarter was bad. Now, question is that at some level, market would think, let's mean revert. Let's go somewhere else. Why one-way street? So there's a short and a long, balance to it. But I would probably think that 2 ways to think about it. That's if China were to rebound, and given that these relative opportunities are very, very good and very cheap, then immediate risk would be that some tactical outflow can happen. Doubtless, that's a risk. But question is how deep that will, how sustained that will, right? My sense is India's rise of structural market is probably is more proven rather than in the past because the macro has been stable, growth has been resilient. So I would probably think that if valuation correct a little bit, there's a case for rebound in India back again. So that effect will be short. Second is China obviously is recovery path, but there's still several macro unknowns, and it's still more tactical rather than structural, right? So while some opportunities may happen and people may seek, but people have burned fingers in China in the first year, and so it would not be too early that entire flows goes back. And third, India and China for most part of history can actually perform together at the same time. They are not zero sum. It is not mutual. It's 1 or 2 years that happens because see, China for a typical year would attract 100 billion inflows. India 10 to 15. Right now question is that for China to rise, India is not a lone market that can supply all the funding and all those things. It can come from elsewhere as well. So put that together, risk is there definitely, but I would probably think that such a tactical risk would create opportunities for India position to become more valuable, and hence this would be very short-lived.
All right, a sell-off in the US government bonds has pushed Treasury yields to a 16-year high, up nearly 5%. This comes on the back of expectations that interest rates will remain elevated as inflation concerns may continue. There are also fears that the rising bond yields may negatively impact foreign inflows into Indian securities. But RBI Governor Shaktikanta Das says India is well placed to deal with global uncertainties. Let's listen in.
I'm referring to bond yields. I'm referring to the policy pronouncements which are coming, the mixed data points which are coming from various economies, the fluctuations in the crude oil prices, and the persisting volatility in financial markets globally.
So what kind of impact do we expect on the Indian market financial stability?
No, financial stability. No, what is different in the context of India. Of course, we are impacted by what is happening all over, no doubt on that. But that's not the headline. The headline is that our macroeconomic fundamentals continue to be sound. Our financial sector continues to be sound. Eventually, in these uncertain times, what matters is how strong are your macroeconomic fundamentals, how strong is your financial sector. I think on both the parameters, India is well placed.
BQ Prime also spoke to Richard Harris and Lakshmi Iyer about the impact of Treasury yield run-up on dollar index and domestic markets.
Normally you'd expect with such a bear market in bonds that equities to come off, and they haven't. We would expect gold to go up in times of crisis. It hasn't. So it is a bit of a topsy-turvy mood. But I think the emerging markets are still highly dependent on what happens in the rest of the world. Yes, you may have some differentials. I mean, India, of course, has greatly exceeded China's performance in the stock market. Partly, I think, because there's been quite a lot of investment there in recent years, outsourcing, this kind of thing, the kind of things that India does quite well. So I think that really emerging markets, and let's face it, India's 120 odd years old, so it's not exactly emerging. But I think that these markets, which are so dependent on how the Western economy goes, they will still be following the Western economies and still have the same kind of sentiment attached to it. The dollar continues to be a safe haven, I think, and continues to spike up whenever we have geopolitical risk. It is even more high frequency than oil in that sort of sense. And I suspect it will be higher for longer. When people can put their money in the bank and earn 5% on it, that's pretty nice. At the end of every quarter, you've got a reasonable return. That's something that, should we say, younger investors have never experienced. And we have to remember that there's a big part of the investing community out there that wants yield, that relies on relatively safer returns. So it's not all bad news as we go out of there. And clearly, while we've got these interest rate differentials, there's going to be an attraction of money into the dollar just to pick up those yields.
So the bond yields already are acting, I would say, northward in response to two factors. One is obviously the US Treasury yields heading upward. And second, more importantly, is the expectation of the impending open market bond sales by RBI. So I think these are the two factors which still continue to be in the uncertain region. However, at around the 5-ish levels on the US Treasury, we think that the rates are kind of peaking out because the US housing data is at a 13-14-year low. And that is one of the clear barometers of the health of the US economy. So I think they're about 5-7 basis points. So I think Indian yields could probably inch closer to the 7.45 region or thereabouts, and then just kind of stabilize there as US yields keep gyrating. So it's very important for US yields to hold on for some time now. If you look at it from an Indian investor standpoint, closer to 7.5 to 7.5%, there is a case to add some duration closer to the 10-year bucket. So within the 5 to 10-year bucket, there is a sweet spot. But clearly, I must tell you that for the foreign investors, given the gap is so narrow, there is still a merit in looking at the US bonds at the current juncture, given the elevated or the inverted nature there. Also, the up to 3-year, 4-year segment in the US, the sovereign US yields are looking lucrative, even from an Indian investor standpoint, to take some positions.
Oil prices extended gains, rising about 1%. The rise was on the back of fears that the Israel-Hamas war may spread in the Middle East and disrupt supplies. Mehika Barve joins us with the details.
Brent crude prices rose by 1.17% to $93.46 per barrel on Friday, potentially marking a second consecutive week of gains. These increases are driven by the heightened concerns that the Israel-Hamas conflict could expand in the Middle East, potentially disrupting oil supplies from one of the world's major production regions. WTI prices increased by $1.22 to $90.59 per barrel, and both the November and the December oil contracts are set to record their second weekly gains. Oil market concerns have escalated following an explosion at Gaza hospital this week and the expected Israeli ground invasion. The oil price is further bolstered by the expectations of a growing oil deficit in Q4 this calendar year. Top oil producers like Saudi Arabia and Russia have extended their voluntary supply cuts all through 2023, and the US inventories are also at a 9-year low. Additionally, OPEC Plus sources indicate that the temporary suspension of US oil sanctions on OPEC member Venezuela won't require immediate policy changes. They thus anticipate a gradual production recovery to maintain a tight global oil supply due to concerns about a challenging global economic environment and weak demand.
All right, now amid global economic headwinds, India has been able to maintain its growth momentum, while IMF expects inflation to come within the target range in 2024. Will continuing external shocks pose an issue? Krishna Srinivasan of IMF shares his insights.
India is among the fastest growing economies in the world right now. Relative bright spot, 6.3% this year, 6.3% next year. We've revised our projection from April, partly because there was much stronger consumption, much stronger investment. Services exports are doing well. So overall, growth numbers look pretty good for India. Inflation is coming down. The most current reading was 5%. So inflation, it had gone up a little bit because of vegetable prices going up and so on, but it's coming down. So we expect, inflation to come down to target in 2024. So in terms of growth and inflation, India is in a reasonably good spot. Of course, if China slows, the question is, does it affect India? And there I would say the linkages between China and India are not that strong. I think our trade is about 4% export share. So if China slows, it may not have a material impact on India. But there are other factors which could be headwinds to growth. For example, the external environment, we've had shock after shock after shock. Now the most recent shock, what does that mean for energy prices? What does it mean for demand broadly from the region and the global elsewhere? So those are key, what I would call as headwinds.
All right, that's all from Let's Talk Business. We'll be back after a short break with more news and updates.